Today, we're talking about a critical mistake that can cost foreign owners of U.S. LLCs a staggering $25,000. This is a penalty that catches so many people completely by surprise, and we are going to break down exactly how you can avoid it. So, let me ask you this. Are you a non-U.S. resident? And did you set up a single-member LLC in the United States? If you just nodded yes, then this entire explainer is for you. Seriously, sticking around for the next few minutes could save you a ton of money and a massive headache. Okay, so what this all comes down to is one, mandatory annual filing required by the IRS. And I mean mandatory, this is not optional, and trust me, ignoring it has some pretty serious financial consequences. And get this, it's not even about income tax. It's about information, and the IRS is not at all flexible on this one. And here's the biggest trip up, the misconception that traps so many business owners. They think, well, my LLC didn't really do any business, it made $0, so I don't have to file anything. Nope, that is completely wrong. Even if your company was totally dormant for the entire year, you are still required to get this filing done. So you're probably asking, okay, if it's not about taxes, why does the IRS care so much? And that is a great question. The answer really boils down to a key legal concept and the government's need for, transparency. So the term you have to understand is disregarded entity. Now, for legal stuff like liability, your LLC is its own separate thing. That's what protects your personal assets. But for IRS information reporting, they basically look right through the LLC and see you, the foreign owner. For their purposes, you and a company are one and the same, and they want to know what's going on. So just to be super clear, this isn't a tax return like you might think. The IRS simply wants a record of who is behind the company, their basic details. And, this is the big one, a log of any financial transactions that happen between you personally and your LLC. It is all about tracking ownership and the flow of money. So what does this actually look like in terms of paperwork? Is it some huge, complicated thing? Well, the good news is it's really not that bad. The entire filing is just two forms that work together. Think of it like this. Form 1120 is just the cover letter. You pretty much just fill out your company's name, its address, and its EIN. And that's it. No financials, nothing complicated. It's just a pro forma wrapper. All the real information goes on Form 5472. This is the main event, the core report, where you list your details as the owner and, most importantly, any of those reportable transactions. And, that brings up the next logical question, right? What exactly does the IRS consider a reportable transaction or a transfer of money? Because that sounds kind of vague. Well, the definition is actually pretty broad. Let me give you some of the most common examples. Did you transfer money from your personal bank account into the LLC's account just to get it started? Yep, that's a reportable transaction. Did you pay for a business expense, say a software subscription, using your own personal credit card? That's a reportable transaction too. Did you take money out of the business for yourself? You guessed it, reportable. All right, so we've covered the what and the why. Now let's circle back to the stakes involved here. Because this isn't just friendly advice. It's a mandatory requirement with a very serious and very, very expensive deadline attached. The timeline itself is pretty straightforward. This filing has to be done every single year. The main deadline is the same as the U.S. tax deadline, April 15th. Now, you can file for an extension, and that will push your final deadline out to October 15th. But you absolutely cannot just ignore it. Which, of course, brings us to the big question. What if you just didn't know about this? What if you're late, or you just flat out missed the deadline? What are the actual consequences? Okay, brace yourself. The minimum penalty for failing to file these forms or for filing them incorrectly is a flat $25,000. And no, that is not a typo. It's not up to $25,000, it starts there. It's honestly one of the most severe penalties the IRS has for what is essentially a simple information return. So, after hearing that, how do you avoid this massive penalty and just stay in good standing? Let's distill everything we've talked about into a simple, actionable game plan. It really just comes down to this simple 4-step checklist. First, throughout the year, just keep a basic record of any money that moves between you and the LLC. Second, prepare that simple Form 1120 to act as your cover sheet. Third, fill out Form 5472 with your details and those transactions. And fourth, file them together on time every single year. That's really it. And it's so important to remember why this matters. I mean, yeah, it avoids a huge penalty, which is great. But it's also just about good business practice. Proper filing protects the integrity of your company, and it makes sure your employer identification number, your EIN, stays active and in good standing with the IRS. At the end of the day, this is the core lesson. The process itself isn't difficult once you know the rules. You don't have to be some tax expert to get this done, but you absolutely have to understand that compliance is not optional. It's a fundamental part of operating a business in the U.S. So I'll leave you with this question to think about. Owning a U.S. company comes with these incredible opportunities, but it also comes with responsibilities. When you weigh that potential $25,000 penalty against this simple task of filing 2 forms once a year, the choice is pretty clear, right? Isn't that peace of mind worth it?